Getting better with the timing. Happy Friday. What's going on, my friends? On the interwebs. Let's get it done. We got things to learn today. We got sound effects to use for sure, and we will be using them. A lot going on. So we're going to talk about the 2-1 rate buy down to kick things off, and then I'll get into my normal timely review of the markets. A lot of stuff we'll discuss today. This inflation figure is a big one. GDP in Q2. I almost nailed that exactly. Some cool stuff that's going on in San Diego. Really cool stuff. We'll look at interest rates. Historically, we'll look at bond market action for mortgage bonds today, which was terrific. Also, we may dive into what took place in the broader markets today, where we had sort of a breakout in the stock market, which is very, very interesting as well. So the 2-1 rate buy down, let's talk about that to start. A lot of people promoting this, and some people have been asking me, hey, is this a scam? Is this some sort of sham? Should we look into it? And you know what? There's nothing wrong with a 2-1 buy down necessarily, but at the end of the day, you have to look at when does it make sense to buy a rate down in general. When you want to buy a rate down, ideally when rates are low, so that you're buying down to a rate that you will not otherwise be able to get. Typically when rates are higher, you don't want to really buy the rate down because there's a better chance, a higher probability you'll be able to refinance in the near future. While refinancing is never guaranteed, here's a couple things that we know. If rates don't go down, our country will be bankrupted very quickly. So the policymakers have a huge incentive to lower rates on a normal basis. When rates aren't low, that would be the exception and not the rule. The rule has to be lower rates just in order for us to pay our bills. So the idea that rates could go higher, much higher from here is kind of, it's difficult. It still could happen, but it's less likely than for rates to go lower. So, but someone told me, but wait, the seller is going to pay for the buy down for me. And this is a good tool for sellers. It is just to entice buyers that, hey, you could maybe get this lower payment for a couple of years and then refinance to get that rate fixed in at the end of a couple of years. And that very well may happen. It very well may happen. And it very well may work out perfectly. It could. But whenever you're buying a rate down, here's what you need to know. You're doing a traditional buy down, you're buying the rate down for the entire 30-year fixed period. If you do a 2-1 buy down, you're only buying it down for the first 2 years. So you're condensing the entire amount of the buy down into the first 2 years, which is more efficient. It is, because people don't tend to have their mortgages for the whole 30 years. But it is buying down the rate nonetheless. And it is sort of creating a norm that is going to change down the road. People don't like it when their payments go up. And that's something that can be difficult to swallow. So you got to kind of really mentally prepare yourself for that. But also, if the seller is giving you the money, then the seller is giving you the money. So the seller's not paying for it. You are. You could take that money and you could use it towards your closing costs. You could reduce the purchase price. The seller's not going to care. It's the same net to them. So just consider all of those options when you're looking at this. Which one is really going to be the best for you? If a seller's willing to do a buy down for you or pay for it, maybe reduce, the closing costs, maybe reduce the purchase price, or, maybe do a 2-1 buy down. Maybe do a 2-1 buy down. I think it is a legitimate product that does have a legitimate place, but it is one of those things that is not for everyone, and you really should take a look at the whole picture. Don't just go, oh, sweet, we get the lower rate for the first couple of years. Boom, let's do it. Take a look at the entire picture and see, does it make sense for you to spend the money on buying that rate down? Because you need to look at how much it's going to cost, which is very expensive. And then how much are you going to get back? What is going to be your return on investment? How much is it going to save you on the monthly payment, so that over that 2-year period, you can see, okay, if it costs us 10 grand, but it saves us 20 grand in payments, hey, that's not too shabby. If it costs us 10 grand and saves us 12 grand in payments, what are we doing here? What are we doing? So just look at the whole picture, okay, when it comes to that. We are live, by the way, on everything: Twitter, YouTube, Facebook, kind of you name it. We're live on it right now. So if you want to drop a comment, if you want to ask a question, feel free to do so, and I will say what's up to you here in just a bit. Okay. So markets today, very, very light. Markets were very, very light today. And what I mean by that is they just wanted to go higher. They did. And it doesn't look like that big of a day when you look at it, But if you watch the price action today, markets wanted to go higher, and we were facing significant resistance pretty much across the board. Every single one of the indices is in a channel, that was, we were right up against the edge of it. So this downward channel, like this is the NASDAQ, for example, and you can see we were right up against this thing, and we've broken out of that. And the S&P as well, broken out of it. The Dow as well, broken out of the downtrend. We are now out of the downtrend. The stock market is now officially out of the ugly downtrend that it has been in. And I haven't changed these drawings at all. For some reason, the one on the Dow got erased. I don't know how that happened, but it broke out as well from that channel. So they're all out of the downtrend. So we're actually now in a mini uptrend for the stock market. Why is that the case? Why is that happening in the face of this inflation and so forth? Well, the market is clearly telling us they believe that the market believes that the Fed's tightening is about to start to get looser. And not that they're going to lower rates, they just raised them, but that they're not going to raise them as aggressively. Maybe next time it's 50 basis points. Maybe the next time after that it's 25, then maybe another 25, and then they'll be done. So the market is telling us that it feels that we're over the hill on this. We're on the other side of the Fed trade, and the Fed controls so much of how the financial markets work. It's crazy. What's really interesting, though, is that not only did stocks rally, but bonds did too. Broke through crucial resistance here as well. I've been telling you this is going to happen. I've been telling you that this looked like it was setting up for quite some time right now, and we're finally getting it. So this kind of hard to see reverse head and shoulders here. I'll do my best to draw it for you. This is bond prices, by the way. So we want these to go higher. We want the price to go up. That makes interest rates go lower. And we've got to a situation where we broke the neckline there, which should lead to, my target's probably somewhere up here. It's hard to say. You never know. We could always this resistance could show up Monday and anything could happen and, boom, we could crater. But it's held its own. And now we're finally at a point where we're actually higher than we were, a few weeks ago on bonds, and rates have started to drop. What's interesting is on that note is that jumbo loans haven't changed a whole lot. But jumbos aren't tied to this as closely. However, FHA, VA, conventional loans, you're seeing lower rates right now, which is awesome. A lot of people don't realize that rates are lower because they've seen the headlines that the Fed has raised rates, and the federal funds rate and mortgage rates are not related at all in any way. Federal funds rate is a very short-term rate. Mortgage rates are very long-term, 30 years. So they're two completely different things that are just absolutely unrelated. The only thing is when the Fed is raising rates, that is a deflationary action, and mortgage bonds and bonds in general hate inflation and love deflation. So the deflationary aspect is the reason why we're seeing this rally on the heels of the Fed. The Fed raised rates 0.75% on this day right here, this day. So on that day, we got a nice rally. The day after, got a nice rally. And the next day on a Friday, which is typically not a great day for bonds. I don't know if my sounds are actually working or not. StreamYard's trying. It may not be exactly what we're looking for, but it does something here. And so broke through on a Friday, which is wild. So that is just showing you there's a lot of underlying strength here. Long bonds appears to be the trade. And who knows, maybe Goldman Sachs is now getting on the other side of this trade. Maybe they're the big buyer. We know they were the big seller. They had a huge quarter and they said, oh, it's our bond trading desk. Well, bonds got killed during that quarter. So you guys must have been shorting the heck out of those bonds. I mean, in like a major way. Maybe they're flipping over. Maybe they're flipped to the side now. And that would cause rates to go much lower. This inflation, so a lot of people kind of immediately, by the way, people are big mad at me for not being bearish enough. And I'll tell you, no, I can't imagine there's anyone else out there who has looked as hard as I have to find reasons to be bearish. I've looked so hard to try to find reasons that I could be wrong, reasons that someone might throw at me. I've looked so far and wide. And yes, there are bad things out there. Not everything's perfect by any means. The things that are struggles are a lot priced into the market, and they're very normal. Like we've had a 10-year wealth boom. The roaring teens, they'll talk about it, 50 years from now. Huge economic boom the last 10, 12 years. And so we need a pullback. We need a healthy sort of correction, and it's not a bad thing if we're getting one. which, like I said, we could be on the other side of it already. We'll see. This inflation figure. So mind you, these inflation figures that we're still seeing this month are all through June. And it was really towards the end of June, the beginning of July, where we really started to see the inflationary pressures subside a little bit. Okay. And it was, and I even posted something. Elon Musk said, hey, the stuff for Tesla, all the commodities used by Tesla are showing signs of decreasing in price quite a bit. And so I posted that, and yeah, people get big mad when I post anything positive. But it is what it is. Bears will be bears, so be it. There's nothing wrong with being bearish, but I would love to hear a legitimate argument or like reasoning or something that made sense as to that I could make sense of for why it would make sense to be bearish. That said, this data is all the same data from the last report. It's all through June. So people who are like, aha, see, you're wrong. We're not on the other side of inflation. It's still there. This is all for the same data period. What I'm talking about is wait until in August when we get the July inflation numbers. Those numbers will be lower than June, and they will, still be up year over year, I'm sure. But month over month, we're going to see a decline, and it'll be the first time that we've really seen a decline since inflation was accepted, admitted to by the Fed, and everyone just sort of knows that it was there because it was there for a while. I was screaming about it. People were like, I don't know what he's talking about. That was over a year ago. Now everybody knows because you've seen it at the gas pumps, you've seen it on the news, it's been there. And so it's a different ball game now. But it's still an interesting read, still interesting information. And the video on there with Rick Santelli is really good. You want to check that out. Here it is. So it came in. So I was predicting GDP to be -1 to -1.5%, -0.9, pretty much right on there. That means we are, in fact, and I was correct, we are in a recession. You'll notice that no one wants to admit this. This is how ingrained politics are into everything now. Politics are so ingrained into everything that people aren't willing to admit the simplest things. They're not willing to define the simplest things. It's truly sad. Notice how they say this: the second straight decline and a strong recession signal. No, that means we're in a recession, guys. And recession is not necessarily this horrible thing. Recessions are either 6 to 8 months, 6 to 8 month time frames, or they tend to be like 1.5 to 2 years. And so those mild ones are 6 to 8 months. The really bad ones are 1.5 to 2 years. And you can see that. And how we know that that's what a recession is, if we go and we look at mortgage rates, so I was going to show you this for a different reason. So let me just pull this back all the way here. The shaded areas are recessions. Okay. Defined by what? 2 negative quarters of GDP consecutively. That's what it's always been. Always been, guys. Come on. Go back to econ. So when we look at these, you can see some of these were longer ones here. That one was went from what? Early November 73 to January 75. So like almost a year and a half for that one. Then here's a short one. That one's just a few months from January 80 to May 80. So not even 6 months on that one. Then you have another one here that's like a year. Then you have another one that's like 6 months, and then a 6-monther, and then a year and a half. And that's what it is. And then the COVID one was a total outlier. It was like 2 months or something. But usually it's either that 6 to 8 months or year and a half ish, let's call it. And I just feel like this one is going to probably most likely be just simply a small one, probably by the end of the year, but the beginning of next year we'll be around the corner on it. You'll see inflation down a lot. You'll see mortgage rates going down a lot. You'll see people buying houses again. It might get crazy again. Hard to say. There's so many people on the sidelines and there's still so much money out there. It's crazy. So we had a 1.6% decline in the first quarter. Oh yeah. And I thought that was interesting. Worse than the Dow Jones estimate for a gain of 0.3. I noticed that they changed that because initially a lot of people were saying, between -1% and 2%. And then they changed it to being a small gain. It's like, wow, are they really going to fudge this number? And they didn't. So at the end of the day, we fell 0.9%. So it is what it is. Here's some exciting news for San Diego. By the way, we're live. Drop comments, questions if you want. We can chat on a Friday. I'm finished here in just a few. I'm going to show you this. Apple buys new campus for 445 milli in a humongous San Diego expansion. Notice where we are here. Is this RB? Y'all in RB? That's my backyard. They're going to build an $445 million expansion in San Diego. Now, why would they be doing this? A lot. You're going to see over the course of the next 20 years, the biggest macro trend probably in technology as it relates to real estate is going to be relocation of Silicon Valley organizations to San Diego. Growth here, pinching there, downsizing there, growing here. We just have a far more affordable place to operate and to live and to pay employees and so forth. So just expect that to happen. This is one of the macro trends I've been following for a long time. Been expecting this to actually be way further along now than it already is, but you're going to continue to see things like this. I guarantee it's a cool article. And welcome to your new mansion in RB, Apple. We welcome you. I thought this was just pure funny. So you could check your savings account and see how much they're giving you from all these rate hikes. How much is your interest on your savings? What kind of CDs is your bank offering? My expectation is they don't want to ever give us that money back, but we'll see. So we already talked about this. What I was going to do here was just kind of zoom in a little bit because it is hard to visualize the other chart. And I know, like, I'm a chartist and I, follow these things regularly. Here's where we are. It's hard to get all this on the screen, but you can see so it shows you the date. So here we are. We had that big spike. Remember, my prediction was that rates would top out at 6.5% this year. And I expected it to happen, somewhere the end of the third, beginning of fourth quarter. Didn't happen. Right in smack in the end of Q2, we hit 5.81%. And since then, we've dropped down to 5.3, back up to 5.54, and then back down to 5.3. That's where we are right now. So that's the average rate on a mortgage, including everything. So every different kind of loan program, people paying points, people getting closing cost credits in their interest rates. It's all mashed into one thing here. And there it is at 5.3%. So a lot of people are getting lower rates than that. A lot of people are, especially if you have good credit or you're getting a government loan, FHA, VA, et cetera. They're actually like a full percent below that. So you've got a situation now where rates have started to come in, as I said they would recently. I pretty much called this whole move here, and there very well could be more coming. This inflation trade, if we're on the other side of it, I'm telling you, there's more coming. So let's be prepared for that. Expect that. What a time to strike. Think about what a time to strike it would be. Right now, the market is sort of dying for buyers. There's still more buyers than sellers, but there's a lot more things happening good for buyers in this market than there have for years. So it's as close to a buyer's market as we've seen in a very long time. So imagine if we have that, and then all of a sudden rates come back in. That would literally be the perfect time to buy. And we're so close to that. Now imagine if we're that close to being the perfect time to buy, and all these people are abstaining, all these people are exiting stage left, all these people are deciding to rent, all these people are saying, oh no, I saw the Fed raise rates, prices are going to go down. I know it. They could be right. It's possible. I just don't think it's the most likely outcome right here. I really think that right now is that time that people should be positioning themselves to do something if an opportunity shows itself up. And that's what I'm here to help with. So I'll be around this weekend as well. Call me, text me, email me, whatever works for you. Let's figure it out. Get yourself pre-approved. If you want to hawk the market, you don't need to be on the sidelines. You can see what's going on. Remember, you don't have to buy a house unless you see something you like. Get yourself pre-approved. Be in position to strike. If that perfect opportunity does come, you're going to have to move fast. So it's better to be in position. There's no cost to get pre-approved. There's no ding to your credit to have it pulled for a mortgage. We've proven that. I've shown you the articles. I can send them to you. I've proven it through case study as well. There's literally no risk at all. And this is the kind of market where you might actually be able to make a huge win for yourself. So give me a call, shoot me an email, send me a text, whatever works for you, and I'll hook you up. Okay. see what we got here. What's up, Nathan? Good advice. He's talking about the 2-1 buy down. Yeah, just know the whole story. Know the whole story on that. It could be a good thing to do. It may not be. It may not make any sense. I'm advising people not to buy rates down right now, but that's just because I'm a pretty firm believer that we're going to see lower rates in the near future. Could be as soon as a few months from now. It could even be sooner. I mean, it could be anytime. If we're on the other side of inflation and the big boys figure that out, they'll know before we will. You'll see rates drop, and then months later, probably you'll see inflation drop. I mean, they will know what's happening way before we do, and that'll actually be the leading indicator, not a lagging one. Thanks, Nathan. Appreciate it. Facebook user, my favorite friend. It's great information. Thank you. Appreciate that. We are not comment heavy today. Nobody from YouTube's commenting. What's going on, YouTube? What are y'all doing? Say what's up. Give me a shout out. Let's see here. There was one other thing I was gonna say. You know what? Let's call it a day. It's Friday. Y'all go out there, have fun. Be good to one another. Love on one another. I'll be here if you need me. You know that. I'll be around this weekend, helping people out, hooking people up. Have a great night, and I'll see you guys soon. Take care.